Good afternoon, ladies and gentlemen. Welcome to this panel, to this session on regulatory matters that the Financial Stability Institute traditionally organizes in the context of the BIS Annual General Meeting. The topic which we have chosen this year is regulation and competitiveness. I don't think I need to spend much time in sort of explaining why we have chosen this topic today. I think it's clear that you have seen actually an important debate going on basically all over the world in relation to the need actually to strengthen competitiveness and growth, trying actually economies to be able to unlock their growth potential in particular. And in that context, of course, you have heard some arguments saying that maybe financial regulation may acting as an obstacle actually to facilitate sufficiently dynamism in economic activity. So the idea basically is that the regulatory reforms after the great financial crisis might have gone too far, that is, they are excessively constraining the ability by banks to intermediate the financial flows of the economy and therefore to give sufficient credit to the real economy. People who actually sort of support those arguments will consider different strategies to correct this situation. Some people will say that it's enough if we basically just to try to simplify the current rules to reduce complexity, with the argument that in doing that you will lower the compliance cost by financial institutions, that will actually facilitate their competitiveness, and eventually that could actually translate into more credit and therefore more economic growth. Others will go further, will think that simplification is not enough, that you should actually go for a more ambitious regulatory overhaul that would imply actually what they would call deregulation, entailing actually sort of a general relaxation of current regulatory requirements. Of course, the distinction between simplification and deregulation is not necessarily clear-cut, but it's clear that for those who use the term simplification, they are implicitly assuming that there is no point in principle to change the objectives of regulation, that we should not compromise on financial stability, but they strongly believe that there is a scope actually to increase regulatory efficiency, understood as trying to simplify procedures in such a way that those ultimate objectives of financial regulation can be met with lower costs for the financial industry. In contrast, those who actually use the term deregulation, of course, they have in mind something different, which is that we should not be that radical in terms of establishing financial stability objectives, that it could be actually a case to weaken somehow that ambition if otherwise we could actually have sort of excessive costs for the financial industry, and the profitability will not be kept above certain limits. So that's a little bit actually the difference I see between those who claim that it's important to make progress in the area in the direction of simplification, and the ones that actually go for deregulation. In any event, it's clear that any regulatory adjustment, whether guided toward a simplification or to deregulation, that will imply significant departures from international standards, such as the Basel Committee standards or the IIS standards, that could actually have far-reaching implications. And this is so because, of course, the objective of international standards is not only to protect financial stability in different parts of the world, but also to establish or to promote a level playing field. So those international standards in principle are important to ensure that we don't have actually excessive regulatory fragmentation, and that will actually imply some sort of competitive distortions, will actually penalize the activity of internationally active financial groups, and that will altogether actually lead to less efficiency in global financial markets. So against that very general backdrop, I think today's panel is supposed actually just to try to explore different angles of this relationship between regulation of the regulatory reform and economic performance. I think the issue is certainly not only relevant, but also quite timely in a context in which, of course, there is much policy uncertainty out there. So we hope that this panel is going to be able to shed light on important matters, such as the evidence on the impact of regulatory reform, or say on growth, competitiveness, but also the scope actually to get a more efficient regulatory framework, so to adjust the regulatory framework in order to somewhat reduce costs for the supervised institutions. So more generally about the right balance between regulatory efficiency and regulatory effectiveness. What is the role of the institutional arrangements to achieve that good equilibrium between effectiveness and efficiency? And also what is the role of international standards, not only in that regard, but also to promote actually more integrated international global international financial markets. So we are very fortunate to have an outstanding set of speakers in this table today. Let me introduce them by alphabetical order. So let me start with Elena Carletti. Elena is full professor in the Department of Finance at the Università Commerciale Luigi Bocconi, but also vice chair of the board of directors of UniCredit. Jonathan Dixon was very well known in this place, in this house, Secretary General of the International Association of Insurance Supervisors. The same for Neil Lesho, Secretary General of the Basel Committee on Banking Supervision. So on my right, I have Caroline Rogers, is Senior Deputy Governor at the Bank of Canada, former Secretary General of the Basel Committee. Marcus Rohner, he's the Group Chief Compliance and Governance Officer at UBS. And last but not least, of course, Sam Woods, Deputy Governor for Prudential Regulation and Chief Executive Officer at the UK Prudential Regulatory Authority. So thanks a lot, all of you, for joining us for this session. Of course, I'm sure that we are going to have a rich exchange of views about these relatively complex but important matters. So the structure of the session is going to be as follows. We are going to have 2 rounds of interventions by our speakers. The first one will be more about general issues, the interaction between regulation, competitiveness, growth, discussion about simplification, about the regulation. And then the second round will be more about market integration and the role of international standards. I think it's important this session is as interactive as possible, so I'll try actually to open the floor for comments from the audience after each round. So you will have at least 2 slots actually just to convey your ideas, your criticisms, to ask questions to the speakers, whatever you feel like saying for each of the rounds. And also, I must also remind you that this session is recorded, so we plan to publish the recording of this session within the coming days. Right. So without further introduction, let me start with a question for Elena Carletti. It's pretty much about this issue, about the implications of the regulatory reform on the competitiveness of the banking industry. Of course, you have seen that over the last few years, you have seen actually relatively significant difference in terms of macroeconomic performance across the Atlantic, but also in what respects actually the performance of banks in both sides of the ocean. So in principle, European banks have clearly underperformed American counterparts. Some people claim that this could actually be a consequence of more stringent regulatory requirements in Europe. Others are not that convinced. So what is your take on this? How do you interpret the available evidence? What is actually the implications of different regulatory sort of frameworks in different jurisdictions, implications of that for the competitiveness of the banking industry in different jurisdictions?
Thank you. First of all, good afternoon to everyone. So thanks a lot for this invitation, Fernando. I feel very honored to be here and to kick off this discussion with the colleague panelists. So let me just make a disclaimer. I'm here today as an academic, and therefore my views are my own one and not at all those of UniCredit in any way. So as Fernando said that there is a very long-standing debate as to what creates this difference in market evaluation between American banks and the European banks. And let me say from the start that I think this is due to a number of factors, some of which are structural and are still remaining there. And therefore, yes, maybe there has been some difference in regulation, in particular in the implementation also of Basel between the United States and Europe. Maybe there has been also a difference in the stringency of supervision between the two continents. But I think solving these issues, even if we put in equal regulation and supervision, this would not solve the problem of the different market evaluation. So let me explain a little bit why. So the usual way in which we look at market evaluation and competitiveness is price to book. So if we look at it over since the global financial crisis, there has been a clear divergence until at least very recently. So there has been the price to book of American banks went up above 1 shortly after the global financial crisis, while those of European banks stayed actually very low, very below 1 until very recently. So just I was looking at a presentation I did in 2019, just to give you a number. The best European banks at the time was the Italian Intesa and actually UBS. And they were trading at 0.75 and 0.73 respectively in 2019. So we are talking about several years after the global financial crisis. If I look at JP Morgan, Wells Fargo, Bank of America, they were already 153, 122, 106. This tells you the divergence in terms of market competitiveness and market evaluation that there was at the time. Now, this changed significantly in the last years. I think it's fair to say that. If I look now at, for example, I was looking last week at the Stock Europe 600 banks. Now there is 117, the index. We have 7 banks in Europe that trade between 120 and 142. The same Intesa is now almost 140. So this tells you that there has been a significant progress in Europe relative to the US. So why that is? Why was so bad initially and why is it improved now? So the magic word here is profitability, ultimately. And let me stress once again that looking at price to book and having a high price to book is not just a matter of rewarding shareholders, but as we were saying before, being profitable is also a matter of resilience for a financial system because it's a matter of the attractiveness of capital. So it's important to consider it. So in the first phase, clearly Europe had a longer crisis. We had the global financial crisis and the euro area crisis. We had interest rates that were much lower for longer in Europe relative to the US. We had the problem of non-performing loans. But this is now somehow is solved. So, and this is the main reason why we saw this big improvement is because the increase in interest rate in Europe in recent years benefited more the European banks relative to the American counterparts because of the different business mix they have. They are much more traditional banks. They have much more reliance on their revenues on net interest income. So even if the net interest margin is not necessarily higher in Europe, the total revenues coming from interest rate differential between asset and liabilities help them in increasing their profitability. And this is, to some extent, the origin of success in recent years, but also the challenge European banks have at the moment. So now that we are in a world where interest rates are going down again, how are they keeping up their profitability and therefore their competitiveness? So is that enough to remove regulation? I think is no, because there are some structural differences that I was saying in the beginning remain there. One of them, I already mentioned, is the different market structure and business model. If you look at the asset mix, in Europe, the loans, for example, count 60% on banks' assets. The same number is 45% in the United States. So this means that the revenue mix in the United States is much more diversified. So even if now interest rates go down, American banks have more opportunities to make profit from non-interest income, and in particular from capital market activities. And this is where is the main difference between Europe and the United States. So is this a regulation? Partly, but even if we solve this problem, we maintain the problem of different asset mix. The other one is clearly that we have a market fragmentation in Europe. Now, as UniCredit, I shouldn't be speaking much about it nowadays. But clearly, there is a problem of not having large players in Europe. And why is that a problem? Well, because in particular, if we want to have innovation and IT innovation and the like, of course, banks need the scale to be able to recover also the fixed costs that come with innovation. So it's important to have larger scale players in the economy. So going forward, yes, Europe maybe want to rethink about the regulation, although I think the SSM currently is very much under simplification and not at all changing anything. So it's of this idea at the moment. But as we argued with some colleagues in a recent paper for European Parliament, I think Europe needs, beyond the regulation, need to really develop capital markets and favor a diversification of businesses for their banks if you want to maintain higher the competitiveness. And let me stop here.
Thank you. Thank you very much, Elena. Very clear. So you are not convinced that the regulatory framework explains much, but you said it could explain partially. So does it mean that it's a well-established fact that regulation is more stringent in Europe than in the US?
I think we can say it's more stringent in Europe, but I think it's important to think in mind that for banks, it's not just regulation that matters, but it's also supervision. And I think in terms of, if you combine the two, I think there is more stringency in Europe relative to the United States. Maybe not for the very large banks, but if you go down also the category, what we have seen, for example, for Silicon Valley Bank is an example of regulation that has been relaxed over the recent years, and that has certainly led then to what has happened, regulation together with supervision. On the issue of competitiveness and how regulation affects competitiveness, I come back in the second round.
Okay, very good. Thanks a lot, Liz. I think that we are going to jump to Marcus. I think it's a natural follow-up to what you have already said. So Marcus, of course, you have obviously following and participating in the debate about possible ways actually to reduce the complexity, maybe the stringency of the current regulatory framework. So do you really believe the current regulatory framework is too stringent or too complex? Do you really think that we have gone too far after the great financial crisis? And if so, you could put some examples about what aspects of regulatory framework could actually be or should be reviewed.
Thank you, Fernando, and thank you for the invitation. Privileged to be here and share, from a bank perspective, the view on regulation. I think I would also like to thank Elena, who speaks out of our heart in terms of there is also attractiveness of capital that is very important, that needs to be considered when doing regulation, and how much regulation really helps to increase resilience versus if you have too much regulation, it kind of hampers also profitability, and as a result may kind of result in unattractiveness for shareholders. Now, first and foremost, I would like to clarify, we strongly support the Basel III and the too big to fail frameworks. We also have implemented, I think, these measures in Switzerland quite expedited, have also fully implemented Basel III finalization, the only jurisdiction which has also implemented already FRTB and also have a multiplier on operational risk assets. So I think Switzerland has gone fast. Switzerland has an extraordinary situation, as we all know, with especially the rescue of Credit Suisse by UBS in 2023. So overall, fair to say that Basel III and its finalization, also the too big to fail framework, has certainly helped the industry overall to cope with extraordinary developments, whether it's the pandemic crisis, whether it has been, again, more recently, Credit Suisse crisis, or also regional bank crisis. As such, I would like to refer rather on specific elements which I believe should be reviewed in terms of real proportionality, targetness of regulation, and where should you probably focus on simplification. The first one, in terms of too big to Basel III implementation, relates to the fundamental review of the trading book, which I would like to briefly comment. The second one is on AT1 and kind of the questioning of this component in core capital as we see across jurisdiction. And the third one is about alignment of what we would say going concern and gone concern standards, and how one should much more focus on how a crisis continuum is being managed. And last but not least, that's not only about regulation, but what we have seen in crisis 2, it's much more about supervision and how regulation is really applied. So on FRTB, I think it's one of the few regulations that has proven to be far too complicated to implement. Only half of the banks that have used an advanced approach under Basel 2.5 are adopting for some parts of their portfolio FRTB. The costs were initially estimated being about 200 million. And this is something where regulation is really not serving also how you improve the management of a bank. The risk management in market risk is not driven by an FRTB regulation. That's really only the capitalization, and there's a significant disconnect between risk management and regulation, how you capitalize this type of market. And that's, in my view, very bad, because ideally a regulation should really also help to better manage a bank and should not primarily serve for kind of whatever abstract capital measurement. We know that FRTB in some instances is over assessing risk, and in others under-assessing. And so here we also see that the jurisdictions have postponed the implementation of FRTB, aimed to simplify. I think part of it is really also now what we heard at the beginning, competitiveness, who is now probably deferring. We have even heard in public announcements that some key jurisdictions have purposely deferred the introduction of FRTB because they first want to wait for until the US has decided on the FRTB. So here it would be certainly very beneficial to revisit, to streamline and make sure that it becomes much more aligned with regard to how could you also enhance risk management in terms of market risk. And again, I believe that there are only very few examples, but this is maybe the most prominent example where regulation is as far off in terms of risk management. The second one, on AT1, we have seen in the credit risk crisis far too much ambiguity. Very important capital component. If used properly, it can really very significantly help to manage a crisis. But the risk is that there's too much ambiguity as to what happens. There's a very significant also difference in terms of how the different capital or jurisdictions have implemented the AT1. If you talk, for example, to rating agencies, it is almost too complex also for them to understand how AT1 is used in a specific jurisdiction, and therefore how do they assess. What they also say, however, it's clear that the more transparency you have as to how AT1 is used, the better it is. And here too, what we have seen in the credit risk crisis, there was too much about stigmas. The people worried about if you do this and this, it's a stigma. But the point is, the more transparency you have in terms of using a capital tool like AT1, the less you will have a stigma. And last but not least, and that comes back to supervision, if people are too much worried about stigmas, they will never be able to succeed in a crisis. They will never be able to take tough measures, because every tough measure has a certain type of a stigma. It's always important to be clear, communicate clear, and also be able to explain to all the stakeholders what the outcome is. Now, on the third element in terms of regulation and where there would be an opportunity to consolidate is more in terms of not having too much of separation between run-the-bank stress-based capital measurement, for example, and then recovery and then resolution, but rather bring it as a toolbox together, be able to use it also. Sometimes there are even different authorities that are responsible for individual steps in this crisis continuum. And it's fair to say the better people are prepared to execute on the toolbox, the better it is. I think it's also fair to say credit risk crisis has shown very, very clearly that on one side, this room can be convinced that it works, the toolbox. If the political side is not convinced, we will also fail to really apply. And I think here too, it's about how do we make sure that the political stakeholders, whether it's finance ministries, whether it's the kind of country leadership, the parliament feels confident that this tool can be implemented without causing undue damage. And here we believe there's still quite some way to go. That said, and that's my last comment for the first question, we do not do ourselves a favor if everybody has her or his own view in terms of whether it works or not. because that's something that certainly undermines in terms of whether people can gain confidence that type of a recovery resolution toolbox would work in a cross-jurisdictional manner.
Great, many thanks. Of course, you touch up on really hot issues in the regulatory debate these days. Maybe Neil or even Caroline actually may want to comment on issues about the Fundamental Review Trading Book, 81, the capital stack. Of course, you mentioned actually the problem of coordination between going concern and going concern. Some people could argue that also there could be the need of some coordination in some jurisdiction at least between the micro and the macro authorities, to the extent that, of course, they will actually have autonomous powers to set the macro potential or the micro potential buffers. And like very much something you have not developed upon, which is this idea of how the scope for regulatory simplicity could actually be enhanced by having a more effective supervisory framework. That's an important idea as well. Great, many thanks. So let me now go to Caroline. Caroline, how do you see this debate? I mean, are you concerned that at the end of the day, this type of revision of regulatory framework would actually lead in the direction of reducing somewhat the scope to preserve financial stability, or do you think that there is an opportunity actually to improve the regulatory framework and to make it more efficient, but still without compromising the ultimate objectives?
Okay, good. I thought you were going to ask me about FRTB, so I'm glad you didn't. Ask Neil about FRTB. Well, first, let me add my thanks for the invitation. It's good to be back in Basel, and it's good to be among friends and colleagues talking about these issues. So I guess where I would start is it's really important to frame the debate well, and to not get ourselves into a debate about soundness and stability and competition as though they were opposite ends of a continuum, or even things at which you have to introduce big trade-offs. I think we've learned over and over and over again that financial stability, what is good for financial stability is good for banks, and what is good for banks is good for financial stability. So framing these things as though they were alternatives to each other, we can either have growth and competition or we can have financial stability, I think is setting the debate off in the wrong direction. So there's plenty of research that tells us that well-capitalized, sound banks lend, and importantly lend through the cycle. So I think that's an important thing. I think understanding, when you think about trade-offs or the continuum and whether we've got the balance right, it's important to set the time frame properly. When you think in a very short term, you can get yourself convinced that there's big trade-offs to be had between growth and competition and soundness. But we were having this discussion just a little while ago before we started. It's often, it's that old expression, where you stand depends on where you sit. And if you sit very close to a crisis, you probably stand differently in this debate. So we also know that gains that come through deregulation are largely privatized, and the costs that come through financial instability are largely socialized. So those are all important foundations, I think, to set the debate off. Having said all of that, I think it would be a mistake, particularly for regulators, to not be attuned to where we are in the cycle. Regulation is always a cycle. And I think right now, what is on the mind of, we're all creatures of our government and our legislation ultimately too, and all of us are being asked to think about whether we've got the balance right. And the crisis that's being debated now, at least in my country, is one about competitiveness and productivity and competition. And so I think digging our feet in and saying there's nothing to be seen here, there's no rebalancing to be had, would be a big mistake. So I am definitely in the camp of, let us start with, and I don't even think simplification is the right word, I think complexity is the right word. I couldn't find Knoll this morning, so I asked Perplexity how many pages in the Basel Consolidated Framework, and it's 1,626. So, and that was after Knoll decomplexified it and streamlined it. So it would be hard to debate, or hard to argue that 1,600 pages isn't probably overly complex. And so it was not to pick on just the Basel framework. I went and looked at my own jurisdiction. Our capital adequacy guideline is 354 pages, and our liquidity guideline is 127 pages. That's, I mean, right there, I think that says we've maybe over-rotated a bit. So I do think there's lots to be gained just by complexity. Complexity has cost, and it has cost not just for banks, but for supervisors. So I think that's the place to start. Whether that's enough, I think that's an open debate. So let me stop there.
Okay, very good. So I think you actually illustrated very well. Again, that the debate about possible simplification certainly is a relevant one. It remains to be seen, I mean, how much you can get out of reducing, say, by a few hundred the number of pages in your regulation. What will be the impact of this in terms of the competitiveness of a particular industry?
Yeah.
But certainly the illustration, I think, is very clear. But let's continue with simplification. And let's go to Neil now, because I think it's often perceived and explained that much of the complexity of the current international standards or regulatory frameworks has to do with the intention to make those regulations sufficiently risk sensitive. And you want to be risk sensitive, which is a good thing, of course. Well, at the end you have to introduce some nuances here and there, and the number of pages increases, obviously. So that at the end necessarily that goes in the direction of more complexity. So it appears to be a little bit of a trade-off between risk sensitivity and simplicity. What is the approach of the committee when looking at this trade-off? And how do you yourself assess actually the current balance between risk sensitivity and complexity?
Okay, thank you very much, Fernando, for that question and for the invitation to talk today. Will I get a chance to respond to the other? Of course. Yes, okay, so I'll answer the question first. It's actually not a new issue for the Basel Committee, this whole issue of this trade-off between risk sensitivity, simplicity, comparability. If you go back, and we actually published a paper on this back in 2013, so we went through this phase where, if you go back through the history of the Basel framework, we started off with a leverage ratio which was very simple, and obviously it could be easily arbitraged. We ended up with Basel II, which was much more risk sensitive, much more aligned to how banks manage risks, and it became a lot more complicated. But what we also learned through that process is that even when you come up with very complicated rules, they can also be very easily arbitraged. So then as a result of that, as we went through the process of thinking about how to change things, this whole issue of simplicity, comparability, complexity was very much front in mind. And it goes back to 2013. And if you go back and look at that paper, it actually lays out all the issues very nicely. And my predecessor, Wayne Byers, and my former boss actually wrote a really nice speech on this exact topic. And I want to quote from it, if I can, because Wayne's a very thoughtful guy, and he says it much better than I could have. So I'm just going to quote from what he says from this speech, where he describes the broad objectives of international policy making. And he says, and I quote, that the policies should be comprehensive yet simple, strong but not burdensome, risk-based yet easy to understand and compare, flexible and adaptable yet consistently applied, suitable for normal times but founded on the lessons from crises, built on consensus but also on the broadest possible engagement, and utilising appropriately the relative strengths of both regulation, that is rules, and supervision, that is oversight. So I think that sums it up really nicely. The problem is, it's actually much easier to say than to do, right? So once you get to the actual point of trying to write the rules, you come up with these very difficult trade-offs. And if you look at the Basel III package, there's actually a lot of things in there that try and address this balance. So for example, if I run through some examples, so we tried to improve the quality of Pillar 3 disclosures. We came up with much more specific templates rather than prior to that it was much more descriptive. We introduced this output floor, which is based on the standardized approach. So when banks are using their internal models, there's this benchmark that everybody can compare to a basic standardized approach with this floor of 72.5%. We place constraints on models in terms of when banks could use them. We completely remove models in some cases where we just thought, you can't really model this, for example, operational risk. So we went through this process of actually thinking through these things. It wasn't as if we just landed on, this Basel III package with 1,600 pages of, I would agree, too complex rules at the end. We actually thought about it and we tried to make changes. Where we did fail, I think, is in, I agree with Carolyn, we failed in the sense that it's still too big, right? It's like 1,600 pages of text. But the reason it ends up like that is because if you ask people in the committee, do you support simplification? They'll all say yes. And there'll be total agreement. And then when you go to the next point, what do you want to simplify and how? There'll be total disagreement. So that's how it ends up being as complex as it is. I mean, it's part of the process of this, getting agreement at the international level. And it's also built on the fact that it tries to accommodate for a wide range of approaches. So you have, things that are very simple, standardized approaches, up to very complicated models-based approaches, like we have for the trading book. So that all adds to the complexity of the framework. If you really want to simplify it, I think what you'd need to do, and I think if you gave the job just to the Secretariat and took the committee out, I think we could write a really nice rule in about 100 pages. I think we could really do it. But that would be, nobody's going to do that, and we can edit that out of the package later. Yeah, in terms of what we could change, I also agree that sort of the capital stack, the number of capital ratios we have is probably a bit overdone. So to just give you one very specific example, most people focus on common equity T1 and then a total capital requirement. I'm not sure we really need a T1 requirement. It just sort of floats in there for no particular reason, I think. You could just have a going concern requirement and a gone concern requirement, and just, getting rid of that, I don't think would change resilience very much at all. It would be a very simple thing to do. I mean, it's kind of a legacy of, I guess, of the whole Basel I, Basel II process. So the other thing I've thought about, and this is the last thing I mentioned in Wayne's, when I quoted Wayne, I think this is something we should actually think a lot more about. And this is thinking about the relative strength of regulation and supervision. And if you start thinking about risk sensitivity, I think the mistake we've made over the years is that we've thought the regulation has to be highly risk sensitive to match what the banks do. But that's kind of a losing battle. You're never going to get there. And the way to actually build in the risk sensitivity is more through supervision, because the supervision is far more dynamic and it's far more specific to the actual risks of the bank. So I think you could think of a framework where you have a much simplified regulatory framework, and a lot of the models, the assessment of models, which are really important, the risk management stuff could be part of the supervisory process. And the risk is you end up with less consistency potentially, but I think thinking about that balance between supervision and regulation is probably another thing to think about. Sorry, it was last.
It's a very good point that follows what Marco said before. So I was saying that one possible way to portray this, to say that you can get more regulatory efficiency if you increase the effectiveness of supervision. You are saying that this actually can be automatically achieved by transferring risk sensitivity from regulation to supervision. But I think it's a very fair point. So let me now move to Jonathan. You, of course, achieved a successful conclusion to the long debate on international capital standards. You finally adopted international capital standards last year, and of course you have gone through the same trade-offs that the banking regulators had to go when actually developing Basel III. So what is your approach in relation to this possible trade-off between risk sensitivity and simplicity? I mean, how you have actually addressed this issue? Mm-hmm.
Well, thank you very much. And after all of these weighty bank discussions, I'm happy to provide some light relief with an insurance perspective. But this language around trade-offs, competitiveness versus soundness, stability versus funding the real economy, it absolutely occurs on the insurance side as well, maybe slightly different language. And this is why we had a long process around development of the insurance capital standard. I think maybe slightly shorter than the Basel standard, but still long. But there the discussion really has been around soundness versus if you like, market development, and in particular, addressing protection gaps. I would say the most difficult part of the discussion was on the life insurance sector, because it is a complex, long-term business model. So you find that even small differences in the approach to valuation can have a big impact on regulatory capital, and big impact for potentially other policy objectives, such as ensuring that there are life insurance products that can support retirement savings and long-term health. The other, maybe a few other distinctions I would mention around the insurance journey that we've been through in the banking side. So first of all, this is the first capital standard that we've had in insurance. So it's taken a while, 13 years since we started just after the global financial crisis. I think learned some lessons, leapfrogged a bit from the Basel process, learned a few lessons, I think, around the balance between risk sensitivity and simplicity. I think it was maybe a more complex task, because on the insurance side, it's really all about the interplay between the asset side and the liability side of the balance sheet, particularly for long-term life insurance products. Maybe slightly easier journey in some sense, in that we did not set out to increase the overall levels of capital in the global insurance sector. It was more about creating a common language. But you asked specifically about how did we approach this issue of risk sensitivity versus simplicity. It was at the core of our discussions. We did want to ensure risk sensitivity, not only because of the information for supervisors, but also because obviously the incentives for improved risk management for insurers. However, absolutely, I think there are limits to the risk sensitivity beyond which it can be counterproductive. But as others have said, easier said than done. I think all of us, nobody is setting out to develop something that is overly complex or overly risk sensitive. But I think we have achieved that with the ICS, and I'll come back to why. But you asked how did we go about trying to get that balance? Well, first of all, it was a very empirical process. So we had 6 years of field testing amongst volunteer insurance groups. And that was a process to come up with a candidate ICS. And then we had 5 years of a monitoring period to actually test its performance under different scenarios and to refine its specifications. which allowed us to test the ICS through the business cycle. And actually we had a lot of business cycle in that period because it included the COVID period and the ultra low interest rate environment, and then the higher inflation period following COVID. So certainly it was a very crash tested standard, and maybe the most empirically tested standard. Secondly, I think this is common in all the approaches, but we did place a strong emphasis on transparency and inclusivity. So we held 4 public consultations, numerous stakeholder events, etc. So it was shaped by diverse perspectives. The last thing I want to mention is that actually we had another special aspect to the ICS, which those of you who are familiar with the insurance system will know that there is a very different insurance framework within the United States. Not only in terms of the regulatory framework and having a state-based regulatory system, but also I think probably in the balance between objectives with respect to, in particular, market development, given the less of a social security system in the US relative to Europe, which of course influences the emphasis on market development versus soundness. And we had an approach where we had to accommodate a regulatory system which did not allow for a consolidated approach to group supervision. And so I think it was a very pragmatic approach of saying, okay, we recognize that and we have to look at whether an aggregation and deduction approach where aggregating solo entities can result in comparable outcomes. And I think that emphasis on looking at, okay, we can achieve the outcomes we want maybe in slightly different ways, does talk a bit to this level of, how much prescriptiveness do you need within the framework, as long as you have some confidence that you're achieving the outcomes. And we actually ended up doing an outcomes assessment to test whether the outcomes through a US aggregation method could produce comparable outcomes to implementation through the ICS. So there's maybe some lessons there around having a look at the outcomes through different approaches as one way of thinking in the design of the system. But ultimately, as I said, I think the balance is good, and the test in a way is going to be in the implementation. Only approved at the end of last year, but the fact that we have commitments from supervisors around the world, including in all regions, to implement the ICS, I think is a good promise that there was the right balance found. So we have already in Japan busy implementing this year a new system based on ICS. I think Solvency II in Europe is largely already meeting ICS, in the UK, in Switzerland, and you have the US finalizing their aggregation method to make sure that they can meet the agreed outcomes of the ICS. So, I'll stop there. A few lessons along the way.
Okay, very good. Jonathan, very helpful. I think the issues are the same. The approach taken probably somewhat different than the Basel Committee. And your remarks, of course, also were very useful actually as a transition to the second round that we'll have later, in which we'll discuss actually how to accommodate basically two objectives of international standards. First, to provide some homogeneity, some clarity of minimum requirements, but at the same time, of course, you have to take into account national specificities. And this sort of outcome-based approach is obviously an interesting strategy. Okay, let me, before we go to that, let me now go to Sam. Sam, you have heard many things. I'm sure you have views about almost everything you have heard. But I want you to devote part, at least, of your intervention to the famous secondary mandate that the Parliament actually gave you to promote competitiveness and growth for the UK economy, provided, of course, that the primary objective of safety and soundness is not compromised. So tell us a little bit about your experience with the actual application of this secondary mandate. You have been very vocal in explaining how you interpret this. That would be great if you guys actually share with us your practical experience with that.
Great. Well, Fernando, thank you very much, and very nice to be here with you all. And let me just pick out one thing from what's been said, which is, Neil, I'm very glad you came in for an extra bite at the end, because I think that thought actually of can we get more of the risk sensitivity through supervision, it's a simple thought actually, but I haven't really thought about it that way before, and I think there's something in that. So it'd be good if we could maybe come back to that. But you asked, and I'm very obedient, Fernando, so I will obey what you've asked me to talk about this new mandate we have in the UK under a law passed by our Parliament in 2023. And actually, as it happens, the British Parliament, through time, has made some quite surprising and strange laws. So, for instance, I don't know if you know this, but in the UK, it is illegal to be drunk in a pub. Now, I don't know if any of you have been into a pub in the UK. I could not possibly confirm or deny, as we're recording this session, whether I've ever breached that law. It is also illegal to handle salmon in a suspicious way. So I may have done that in my kitchen. As far as I know, I haven't. It is illegal. This is useful to know actually if you're in London. It's illegal to carry planks of wood along the pavement. That is an easy one to get wrong if you're building a house in London. And the last one that I discovered recently was it is illegal in the UK to offer a beached whale to the king. And I can confirm I have never breached that law. But as it happens, the law that Parliament passed in 2023, as you were saying, Carolyn, we're the servants of Parliament, so whether I like it or not is sort of irrelevant in a sense. But as we're in a more informal session, I think it was a very sensible law. Now, why do I say that? In the UK context, this happened in the context of Brexit. So those of you familiar with the EU system will know that the rulemaking, almost all of it, the most important bits in an EU context are overseen directly by the politicians. And with Brexit, that lawmaking was pushed down to us in the regulator. So Parliament in the UK said, well, okay, if we're going to take this activity, which has been politically overseen up until now, and we're going to push it down to you and the regulator, then you must take into your mind some more of what we have had in our mind when we controlled it directly. And that thing is competitiveness and growth. And I always thought that was a very reasonable argument for Parliament to make. And more importantly, perhaps, it was done in a very sensible way, in my view, for the reason that you touched on, Fernando, which is it is a secondary objective. So it recognizes that the primary contribution that an organization like ours can make is on its primary objective of financial stability. But subject to that, we should do as much as we can to promote competitiveness and growth. Now, when we were given this new objective, many wise people said to me, this is a stick with which the industry will beat you. This turns out to be true. We are being beaten ceaselessly by the industry. But being beaten is not always unpleasant. And I think this will proceed in phases. So the phase we're in at the moment actually is not so bad. And the reason for that, in my opinion, is this, that we've been through a phase of very, very significant regulatory expansion, indeed a revolution. On the prudential side since the global financial crisis. We've also had a lot of development on the insurance side, as Jonathan was outlining for us. And it's of course the case that when you go through such an enormous change, you will create some things which went a bit too far, were a bit too complicated, or which when you look at it in the round, you actually didn't need them. I think it would be extraordinary if you went through a process of that kind and you did not have anything of that sort. So what we're doing at the moment is going through, in particular our regulation, and looking at it again through the lens of a new objective, but with the financial stability still as the primary, and saying, well, what is there that we can change here? And at the moment in the EU, when I hear this debate, a lot of debate, and this come up a bit in the session today, is simplification, not deregulation. to be honest, I don't really think that works, because some of the stuff we're doing is actually removing things that we thought didn't work. So we abolished a thing called a bonus cap, which some of you will be familiar with, just because we thought it was a bad idea. We're doing something on banker bonus deferrals at the moment, where the UK deferral regime effectively takes senior manager bonuses out to 8 years. We just think that's too long. We overdid it in that regard. We're going to bring it back in. We'll have an announcement on that in due course. If I hop across to the insurance side, we've actually chopped a third of the reporting that we get from insurers. Now, we may, of course, have chopped something there that's very important, but our assessment is that we have not, that actually having used the machinery for a few years, that actually we don't really use that bit, or that bit doesn't really do what was intended. We can get rid of that. So all of that, I think, is fine. But final point, Fernando, is this thing, history tells us this thing will proceed, right, into a different phase. And it will move into a phase which may be starting to come now, where some participants in the game argue for things to be cut which are actually very important for financial stability. And that comes back to the point that Carolyn was making, is there is not a trade-off in the long run between financial stability and growth and competitiveness. And just to finish on this, that's why I think our Parliament did do a nice job on this, because they recognise that quite explicitly. And I think as long as the growth and competitiveness part of the mandates of regulators like the one I'm in charge of have that shape, you can achieve a lot. But I think you can have your cake and eat it. You can achieve some things without threatening financial stability.
Okay, very good. I think it's a good point what you made on this idea of simplification, the regulation. I mean, now, of course, those two terms are used as to signal different approaches in relation to the possible regulatory adjustments. But it's true that you think about it, does not work really well, right? I mean, one way to simplify, of course, to strike out actually some rules. I mean, this is clear. Anyway, so as I promised, I think I'm going to open now the floor for questions, comments from the audience on this matter. Yes, Yoshi? Somebody else would like to speak? Okay, Yoshi first.
So Yoshi Kawai, I know everybody, but I'm now work for OECD as a chair of the insurance committee. One anecdote, just, I remember when I was an IFSB member, 2006, just before financial crisis, there was a serious discussion of simplicity, and one argument is even capital was so high, 2006. And then what happened afterwards, So I don't know what's the sort of rationale to discuss this issue. And one just a different perspective. After financial crisis, the two major reform is capital add-on and resolution. I just want to ask Marcus definitely this issue, because resolution, I think, and everybody is convinced, this is definitely one of the most important regulatory tools, and as you experience, Marcus. But of course, it's burdensome, complex, and so on. And of course, capital, in a sense, it's much simpler add-on, and of course, there's some complexity. But I want to see this resolution issue specifically in this context. Is it really well functioning? Is it just, it's really played the role, particularly based on, Marcus, your experience. Are there any room for improvement? Because first of all, I just want to ask you, particularly, this resolution has very good rule of the game. And are there any room for improvement? What do you suggest? I think it's a very critical question because of this financial crisis and particularly your experience.
Yeah, thank you for the question. And we actually do we do a private resolution of Credit Suisse now as part of this rescue transaction. And what we have seen is certainly without all the preparatory measures, which were part of the toolbox of too big to fail, and the resolution would have been much more challenging. So the level of preparedness was much better. Now, what in my view didn't work that well, and in the Credit Suisse example, was when do you start to intervene that you see a bank derailing from demonstrating a sustainable business model. And Credit Suisse was a long-term crisis evolution. And everybody saw it. The market recognized it back in 2020. Years of kind of crisis evolution and people not taking action. People in the bank, people also at supervisory level. And always kind of referring to, did we have the right tools? The point, however, was more that if I go back and say what could be done better, A is much more flexible response to a crisis evolution. Post-global financial crisis, everybody focused on this particular event of a huge capital drain due to losses, and you had the bail-in and you had the restructuring, focused restructuring. The Credit Suisse example showed that it was kind of such a depleting of trust that the bail-in and target restructuring wouldn't have worked. That's why we also, and I think in the UK have it also, will have much more flexibility in terms of a toolbox where you say you need to be also able to have an orderly market exit. You cannot only rely on, say, you do a bail-in and then the firm continues to exist, kind of literally it's in existence. The second one is, and that was the eye-opening, as I was also involved over this rescue weekend, bringing together the authorities and the parliament, for example, who needs to approve, for example, public liquidity backstop, has also shown that there is a lot of work to do to get the confidence on the parliament side that this works really. Because we, as I said, may all be convinced that it works. We know the bail-in will work, and we have done a lot of discussions with the SEC also in terms of really making sure that it will work. But then the point will be you have a public liquidity backstop, and where in our case the parliament will need to approve, for example, the facility. But if there is then too much of hesitance in terms of whether it really will work and worry, then you undermine the entire toolbox. So I think one thing is certainly what we say, testing with different crisis scenarios. So like in our firm, we have now 4 different crisis scenarios with regard to idiosyncratic versus system-wide, in terms of fast versus long, and how would you respond, and then have the toolbox and what type of measures would really work in a given crisis. But then also have very clear roles and responsibilities, and do testing, ideally, not only with authorities, but also with political representatives that really understand that this will not be the first time you go through if you're in that weekend, because it's a pretty short period of time to explain to somebody how it really should work. And I think that's something we need to learn from the crisis, and we also provided feedback to Fernando and his team in terms of lessons learned. We did a kind of a report what didn't work. And my last point will be what I mentioned before. I think people always coming with stigmas, you can be absolutely sure those will never be able to really manage a crisis, because a crisis will need to have tough decisions and people should not be hiding away. And moreover, authorities should not justify people not taking actions because always referring to stigmas.
Thank you, Marcus. I think Caroline, Sam would like to say something about this, please, briefly.
Yeah.
Caroline.
So, I mean, I think it was, so I'm picturing us inviting our Minister of Finance to our tabletop exercise and wondering how that would go. But your point about, you know, banks are basically, they're global in life and domestic in death, yeah. I wanted to pick up on your point, your first point though, and this is, I think, picking up on Neil's point. One of the concerns I have about the discussion that's happening now about what needs to change in bank regulation and supervision is the debate around how much discretion or how much judgment supervisors should have. There is a discussion in the US, for example, that we should be removing the M from camels. I think this would be a disaster, quite frankly. I think, to Neil's point, one of the ways you remove complexity from the rules is that you give more discretion to the supervisors to respond, to adapt the rules to things like business models and economic environment and the types of risks you're talking about. Because what we've seen over and over again on banks that fail is they have enough capital, they meet their capital and liquidity requirements, and they fail anyway. And Credit Suisse was an example of that. And the lesson learned was, I think what I heard you say is the supervisor should have been intervening much earlier on based on business model, and we don't have rules about those things. We need to trust our supervisors. So I'm very concerned that this debate about the balance between supervision and regulation is going to end up going the wrong direction. So I'm glad to hear a bank argue for stronger supervision. So.
Not all banks. Sam, please, and then we got
two very quick comments. One, On the resolution side, Marcus, I like your use of the word toolbox. This is how I think about it. You want to have options when you hit the crunch. My experience at 23, both Credit Suisse up close, Silicon Valley up close, was to come out of it feeling much better about the toolbox. Like it really was much, much better than it had been previously. The most important thing to do, though, which was not done in the Credit Suisse case, was actually you could have used a resolution tool. We would have used a resolution tool to achieve a similar but neater result. And I think that was a little missed. But Swiss colleagues were having it was a difficult situation, obviously. And second point on the business model, it goes back to what Elena said at the beginning. We pay a lot of attention to business models because we think if banks making decent money, that's basically helpful for their resilience. Having said that, if you have a firm, and you gave the example of Credit Suisse, whose business model is not that great and it has this kind of trouble, it is actually very difficult to do two things. One, it's basically impossible for the supervisor to fix that. And two, it is actually very difficult to intervene. You walk into the board and say, we're going to resolve you because your business model is no good, right? So I think it's quite easy to say they should have done. I'm not so convinced. I think we just have to accept that some firms will die because their business model was bad and we deal with it at that point.
Okay, so we have Roberto Campos and then Steve. And then we move on, please. Roberto.
Thank you, Fernando. Now, a couple of comments. First, on Professor Elena, on the difference between profitability and actually pricing of banks in Europe and US. Before being governor of Central Bank, I worked for a global bank for 22 years. And we used to have these meetings here at the BIS with the CEO of all the banks. And in every single meeting that we had, there was a lot of complaints about CEOs of European banks that the regulators are too hard and that's why they are not profitable, including my former boss. So I decided to investigate that. I did, it was like a 2 or 3 months work. And at the end, I found that most of the difference in profitability is explained, it was like 88% by capital markets. And even when you look at banks within US, you can explain the difference between the market share and capital markets. And then someone said, but capital markets will eventually even out. What's happening right now is the opposite. If you look in emerging market emerging market countries, you have a lot of companies delisting and listing US. US capital markets after the crisis went to 50% of global. Now it's moving to 64%. So it's increasing more and more. So I think it goes back to the business model. One other comment on the after 2008, another regulation. One of the things that being running global markets for a long time that I think needs to be reviewed is the trading books. It's very complex. Anybody who looks at FRTB and segregating the desks, and what that has done in the latest years is has moved market making out of the banks. And this moving market making out of the banks is a problem for the markets because a lot of companies, when they quote long-term hedges, they need banks to guarantee the hedges on the market making. And in some places, you don't have that function anymore. You have hedge funds doing that function in a much more expensive way, and I think much more unregulated way, and it's not being done well. And my last point is on COCOs. Yesterday we had a presentation here, and someone showed a graph, which a lot of people who are in the bank know already, which is COCOs have a lot of cross holdings. A lot of banks own COCOs of other banks. And I remember being at the bank, when I look at that, I said, this doesn't make a lot of sense. And I started looking at that. And it so happens that the cross-holding is so big right now, that if you could, like, and Hagu yesterday gave a suggestion that the banks should not be allowed to have COCOs from other banks. And I'll tell you, if you do that, you won't have COCOs anymore. Because the cross-holding is so big that if you adjust the pricing for that, you probably wouldn't have a market. So I think that's something that eventually regulators globally will have to look at it because the cross-holding is so big right now and it's increasing. And there was a part of the report that was presented yesterday that has a graph that shows that. Thank you.
Thank you, Roberto. Steve, check it, please.
Thank you very much. I used to be in this building. I'm now a member of the European Systemic Risk Board. When I was in this building and we were working on the first iteration of Basel III, I had a couple of rules of thumb about it, which I hope people keep in mind. The first one is that one of the reasons to have the regulations, at least the way that we do, is because of a certain set of externalities that are responses to subsidies and backstops that we provide. The fact that there are externalities means that what we're doing is we're trying to change the behavior of people, and they're going to complain about it. So rule number one is if they're not screaming, you're not doing enough. Okay? That is, and so Sam, when you said they're hitting you, great. That means you must be doing a good job, okay? Maybe the wrong people gave them the stick, but that's the second thing is that I think that we have to realize and accept that there's always going to be gaming and that there's an arms race between the official sector, the regulators and supervisors on the one side, and the banks on the and the private sector on the other, and that's an arms race that it's very, very hard for the public sector to actually compete in. And I would suggest that's going to get harder with AI because they're going to be using tools to that are going to be even more difficult for make it even more difficult to actually find what it is that they're doing that's risky. And given that, I wonder, and I think that Neil's comment about where the complexity is actually coming from, I really wonder whether we shouldn't go back and throw it all away and say, let's just set a 15% leverage ratio requirement. You know, set the requirement really high because you'll assume they're going to game everything all the time. And why not just do that? It's going to be a lot. I mean, yeah, okay, now we have to have a debate about what's in the numerator and what's in the denominator and all that kind of stuff, which is a different debate that's going on now. But it seems to me that the way to do that is not to let the perfect be the enemy of the good. Do something that's actually going to work and get rid of all of this other stuff. Get rid of the rule book. Get rid of the needs on the part of the banks and set the leverage ratio very, very high. And just move from there, and just force them to shift from debt to equity financing. There's no evidence that I've ever seen that shift actually reduces the amount of credit on the balance sheet of the banks. Thank you.
How much liquidity do they have to hold? Right?
This looks like a proposal to raise the output floor above 100%, right?
Yeah, it sounds good until you're. Yeah.
Many thanks, Stephen. I don't know whether there's any quick reaction, otherwise move on to the second part. Yeah, maybe Elena, you want to?
So first of all, I think we are in full alignment. I mean, capital market explain a big difference of the performance, and therefore it's not just about the regulation, as the CEOs of European banks tend to complain about. But maybe I just would like to say a few things about what has been said. I think on the resolution, I think it's great that we have it there. And I agree there is a lot of preparation, but two things that I think are important. One is bail-in. I think a bail-in is very hard to apply in practice. I mean, the risk of contagion and the risk of externalities that come from bail-in is really very important. And second is the importance to have a backstop. And the case of Credit Suisse shows that very clearly. And this, I think, is one of the main deficiencies that we have in the European resolution framework currently. So Europe would have not been able to do what Switzerland did with Credit Suisse, for example. And then lastly, supervision. I'm all in favor of increasing the role of supervision and give more discretion. But let's not forget two things. First, they need to have real strong powers to intervene, tools. And second, banks move much faster than supervisors. So it's hard for supervisors sometimes to actually know. I mean, think of investment now, innovation, AI, and all these things. Supervisors tend to be a bit slower on that. So if you really want supervisors to be much more active, you really need to equip them with the tools and the knowledge and the advancement and the training that they need to have in order to face banks. And that's not necessarily easy.
There was 16 billion francs bail-in, right, in the case of Credit Suisse?
I think there were the liquidity backstops that were provided. There were actually, I don't remember now,
No,
but
but
there were.
you're saying that you were not very
No,
confident
what I'm
bail-in.
saying is that the bailout, the backstop in Credit Suisse was very important. The liquidity backstop that was provided,
No, sure.
and also what was offered to UBS in case of problems in the portfolio that you.
Yeah, but there was bail-in as well, that's the only point.
No. Yeah.
Okay, so I'm going to relax on this because I think the discussion is quite interesting. So Neil wanted to say something, I think Caroline as well.
Oh, that's,
No, not anymore?
we can move on. We can move on.
Can I say something?
Oh, yes, I give you the floor already.
No, thanks. But just on the cross-holding of COCOs, I mean, I agree it doesn't make any sense. I'm a bit surprised that it's that high. I had no idea it was that high, but I agree it doesn't make sense for banks to be holding COCOs.
But there are also limitations to hold. You know, as a bank, you have limitations how much you can hold in COCOs or loss absorbing debt.
Yeah.
I know he was talking about holding COCOs of
Cross.
other banks.
Yeah, sure.
Yeah,
But at
cross-hold.
the end of the day, not every bank hopefully will kind of go down at the same time, because otherwise you have another problem now. So if you have a portfolio of loss absorbing debt in banks, there's limitation in
Isn't it
terms
the
of how
worst
much
place
you
to put it in another bank? It just doesn't make any sense.
I think it's
The
just
prob-
subtracted from your own holdings, I think it's.
The probability of you going down more than one at a time increases if you're holding each other's COCO.
Yeah.
Well, on
Okay,
Yeah.
order, please.
But
Anyway,
there's
I agree
ruling,
with
that's what I mean.
I mean, yeah, I'm glad you raised that point because another thing that is going on, which you probably also have been focusing on, is the financing of significant risk transfer trades from banks.
Yeah.
So, I mean, this is just kind of completely wrong way around, right?
Yeah.
So, of course, we haven't yet found a bank that's financed its own SRT,
But you will.
but
eventually.
it's going to happen, right? This is madness.
And I just want to make one other point, not unrelated to that, and this comes up all the time, is who's got the strictest capital requirements? Like if you ask, European banks, if you ask US banks, if you ask Canadian banks, if you ask Swiss banks, if you ask Australian banks, and I do, they all tell me they've all got the strictest capital requirements. And they can't all be right. And the best comparison we have, and we collect the data here across all jurisdictions, and we are able to calculate the capital requirements based on the assumption that everybody has the exact same rules. And what do you find? They all come out roughly the same. So the argument that somebody's more strict than other, no,
On average.
I don't believe it.
It's only an average.
But even on average, yes, on average, but even within an institution, even within a jurisdiction, then you could make the argument that somebody's stricter on one bank than the other. But the general argument that's one jurisdiction is systematically more conservative than another, I don't buy that.
Great, thanks. I think Bertrand wanted to say something. Not anymore? Yes.
I wanted to react to two things. The first on AT1. So I was also surprised a little by the data that I saw yesterday, but I think perhaps also as Markus Rohner said, given the fact that the capital treatment when you hold COCO of another bank is very strict, even if there are some holdings, I would say it doesn't really hurt to writing down. And we know it now from experience with Credit Suisse. COCO has been written down, and I didn't hear any bank saying, "Oh, it hurts me." Okay. Then I would have one question to Sam Woods, and we always talk about compensation, but I understand the UK decision, to abolish the cap on compensation, because I think the reaction of banks when we introduced the cap, it was just to increase fixed salaries, so you could comply with the cap. But I'm more surprised, by what you have said, that you think the deferrals that you have in the UK are too long, because, for example, based on the experience of some underperformers, Credit Suisse was one, but we all know there are also underperformers. I think one experience is that it takes quite a long time to measure the true performance of a bank. And so short deferrals can allow a bank to distribute high bonuses, and perhaps 3 years later you see that, well, we shouldn't have distributed these bonuses.
Maybe I can respond to that. Look, I have a lot of sympathy with the substance of your comment. Look, my first involvement in this whole world was bailing out RBS in 2008. And actually, I had to deal with the various bonuses that had been paid there. And I'm absolutely convinced that part of what took the system over the brink in 2008 was if you present somebody with a incentive system where they can walk out with 1, 10, 20 million in cash at the end of the year with no more questions asked, even quite reasonable and public-spirited people will do some pretty extraordinary things presented with that. And that is incredibly dangerous in my view. There's a place for those packages, but it's not in the part of the economic system that holds all of our money. Our observation is more just one of degree that we looked at. We looked at the profile of incidents which had actually resulted in adjustments to bonuses. And the data is not that great, but we saw we could get quite a lot of it in a shorter time frame than 8. We haven't quite decided where to come down to. We've consulted on something around 5. It also goes a bit to the competitiveness point, because we did also look around other jurisdictions. What do others do? And on that, it seemed we really had become an outlier with only one other jurisdiction anywhere close. So there we weighed it a bit in the balance. So yeah, there's a bit of a judgment there, I guess.
Great.
Can I ask a question? You don't have to ask me a second round question. It's a really basic question.
Okay, go ahead.
It's just sort of triggered by Sam's comment. It's going to sound a bit odd, but what are we actually talking about when we talk about competitiveness? Like, if you start thinking about, are we talking about competitiveness of, payments? Seems to be pretty competitive. Are we talking about competitive of providing debt, credit? I don't think many people think there's a lack of debt out there. Yep. Are we talking about competitive of other services? Are we talking about competitiveness, which you just mentioned, across jurisdictions? Yeah. And if that's the case, then why change anything? I mean, you're not gonna. If everybody has the same rules, regardless where you calibrate them, you get the same level of competitiveness. But I think we've been using this term without, well, in my mind anyway, it's not really being clear what we've been talking about. But
well, I guess people in the debate are using competitiveness for different purposes, right? The Europeans saying that they are not competitive because whatever, regulations too stringent, right. Or you have the whole banking industry thinking that they are losing competitiveness vis-a-vis the non-bank financial intermediaries because they are less regulated. I mean,
maybe this is the perfect time to go to the second because it's
I have no more questions.
Because the question you were supposed to ask me now is precisely
great, Elena. I love you.
You can skip me in the second round.
Yeah, I think you skip Neil in the second round.
Okay. I'll take a pass.
Okay, so maybe I can say just without you asking me the question. So what does it mean?
Sorry, I just asked my job. You see?
No, I mean, first of all, so the question was, what is the level, how regulation affects competitiveness, in particular when there is differences in regulation across jurisdictions. So this is part of the question that Neil had. First of all, competitiveness is not competition. So it's very different, right? So competitiveness refers to the ability of the banks to outperform rivals in a way. So it's completely different from competition. So yes, there is a lot of debt out there. It doesn't mean there is competitiveness. So in that sense, at least. But let me just, I thought of answering this in two ways. And I would slightly disagree with Caroline that there is no trade-off between regulation and growth or stability. I mean, between stability, if you want, and competitiveness in the long term. So let me just say, so first of all, if I look at how banks behave across jurisdictions subject to different level of regulation, so take a banking group that operates across different jurisdictions with different regulatory stringency, there is very strong evidence that banks move activities towards jurisdictions that are less stringent in terms of regulation. This is true, for example, for capital market flows, but it's also true for jurisdictions that are subject to different supervisory regimes. So banks move even syndicated loans in jurisdictions where supervision is weaker or where supervisors don't participate in cooperation agreement. So in terms of competitiveness across jurisdiction, I think it's fair to say that there is a hurt of competitiveness because otherwise banks wouldn't move activities. And in particular the case when the country that is less regulated is a developed country with strong property and creditor rights. And if we think of the debate we are having now, in particular the fear that the US made decouple, at least partly, that would really be the case. So it would potentially be able to attract a lot of capital flows from other jurisdictions. So now we are left with the question, why is that? So, and if you have integrated markets and banks compete, now they compete with each other in a market, but they, in their domestic jurisdiction, they have different regulatory intensity, then what happens? So then it goes to the question cost of equity, regulation and cost of equity, because if you have two banks with different regulatory stringency and there is no competitiveness, means that the one subject to stricter regulation should have a higher cost of equity, and therefore it should have higher lending rates ultimately, and this would hurt competitiveness. So now we go to, Steve said that there is no evidence showing that stricter regulation affected the cost of equity. Well, it depends whether we divide between short and long term, because ideally we would like to have evidence on, in the long run, what is the impact of a regulation on the cost of holding equity, not issuing new equity to comply with the regulation. And that, it's fair to say, is very difficult to measure in reality, because econometric studies need to establish causality. So they need to establish now exogenous shocks, and then you see what happens. But these are the short-term effects. But in the long term, we can establish correlations. We can do calibrations. But calibrations are based on assumption, and correlations are correlations. There are a lot of other things that come into play, and therefore it's very difficult to explain. So what we are left with? So I think in the short term, we know there is a cut in lending, there is an effect of imposing higher regulation. In the long run, maybe there is a bit less, but I think it's fair to say there is evidence that there is a little bit of negative impact on competitiveness also in the longer run. Otherwise, we wouldn't have this regulatory arbitrage. Otherwise, we wouldn't have some of the things we see. So to the extent that there is a trade-off, this trade-off may change over the business cycle. It may depend very well on the differences in regulation across countries. So, of course, it would be ideal if there weren't these differences across the regulation, because then you wouldn't have the possibility of arbitrage in this way. Let me stop here.
Great, Elena. Many thanks. Very, very clear. Something that in any case worries me is that you would expect in principle that more stringent regulation following your arguments could actually imply lower market valuations, right? And this is, you look at actually data, you see, for instance, in the US in particular, market valuations are now the level they were before the great financial crisis, and therefore before actually the regulatory reform afterwards. Of course, they have adapted, or they have tried actually to find ways actually to keep profitability while having to face more stringent requirements, right? Yeah. Okay, very good. So why don't we move now to Marcus, actually, because I think it's a good complement to what Elena said. You are a member of the bank, which is active in 50 plus jurisdictions, more or less. So you have to face different regulatory frameworks. How do you see how do you see this regulatory fragmentation, or regulatory diversity at least, is affecting actually your efficiency, your operational cost, your ability to compete with domestic players?
Yeah, so I think it's clear if you operate in a country, you kind of apply the local rules, and you need to be aware that this is the game, the rule of the game. The point is more, we all talk about prudential regulation, but there's much more. There's a lot of conduct regulation, which by now is much more expensive, by the way, than implementing prudential regulation. I think on the prudential regulation, where I would see the biggest benefit in terms of greater alignment is on stress-based capital measurement. And maybe there's far too much effort in trying to have everybody inventing its own methodology and trying to figure out what is being even more sophisticated, instead of having a more coherent approach and really then use it as a true tool both for a bank and for the supervisor, including, for example, for a core college, because I do believe, for example, post-global financial crisis, the colleges are certainly kind of day and night how regulators are cooperating across jurisdictions. And there you see also, it goes back to resolution planning, where we have much more of a coherent approach in stress-based capital measurement, and how you manage crisis is totally fragmented. And that's something I believe that would be the biggest benefit also, because it will bring the supervisor much more closer together in supervising also these global banks. Moreover, you wouldn't spend a lot of time and money and have complexity that people struggle to even understand what the underlying scenarios are, and therefore again keep it too abstract for as being a management tool also for the bank. And that's something which would be beneficial again in terms of promoting a more coherent approach. The other one, in my view, the biggest challenge we'll face is this rapid development of innovation and changing the landscape. We will not have the time to develop another 1,600 pages, I'm pretty sure, because it will go too fast. And the question is more on the principle-based regulation on key topics, whether it's virtual assets, digitalization, use of the coexistence of probably the fiat system and the digital currencies, but then also the use of AI and what it really means in terms of changing the industry, because this is of transformational nature. And I think another topic, a very important one, is also what is, I think, very positively, not because we just have, I think, the UK represented. The point is, NBFI transparency is really lacking. And Sam and his team have really promoted also how do you start to get transparency. Because that's one of, I guess, unintended consequences that you see this massive transfer into an unregulated space in terms of credit, in terms of also potential evolving risks that are also getting into the financial system. And here too, to get this type of, for example, risk aggregation and have a consistent methodology cross-border would greatly help, because that helps to manage the bank. And here too, doing it fast and rather have 80-20 than losing a lot of time until we have a perfect solution that will be likely the name of the game, that people will be able to say, we can do balancing off between trying to have the perfect solution in regulation or whatever, versus having a very practical means how we cope with these rapidly developing changes in the overall landscape.
Great, thank you very much. Let's now move to the issue about implementation of international standards. I remember you gave a speech, I think, what was it, 2021 or so, saying something like you were quite optimistic about the future international regulatory cooperation. You were not, at the time, you were not that optimistic about actually the implementation phase, so that will be a big challenge to have a consistent implementation of the international agreed standards in the different jurisdictions. Well, this is something that is becoming now quite relevant. Mm-hmm. So tell us a little bit about your arguments and how recent developments have modified your assessment, if at all. Huh?
Well, I think in that speech I sort of made the arguments that Neil made earlier, that I think you have to think about the sources of fragmentation. So, and in my experience with the Basel Committee, there's sort of three sources of fragmentation. The first one is kind of unavoidable. I mean, each jurisdiction has its own mandate articulated. You've got common law and civil law jurisdictions. You've got supervisors or regulators with different degrees of sort of enforcement and discretion. You've got different bankruptcy laws, comes into play in resolution, things like data localization and privacy. So every member of an international standard setting body has to go home and contend with those frameworks, and often that results in a certain amount of fragmentation. But I would say that that's the smallest part. The other two parts are the one that Neil mentioned, which is relentless lobbying by banks to have things that are unique to their business model or their jurisdiction incorporated into a global standard. And that introduces, I think, a lot of complexity. And then there's usually two rounds of it, which is, I think, what I pointed out in that speech, is there's an argument at the global level, and then they reopen some of the closed arguments when it's time for domestic implementation. The third source of fragmentation is, I think, from the member regulators or the member supervisors around the table who try to solve a domestic issue at a global table. So they'll bring a problem, they might be having trouble getting something done in their own jurisdiction, and if they can get it into a global rule book, well, then they have a little bit more a bit stronger argument when they go home and try and get something implemented. Or they have something very unique in their jurisdiction, but they really feel strong that it needs to be in the global rule book. So, I mean, I think those are the three sources. The number 2 and number 3 are by far, I think, the larger sources of fragmentation. How do you unwind that? I mean, I think we have to remind ourselves, back to the simplification, the complexity. The global standards are minimum standards for one thing, and they're for globally active banks. I think if we all set ourselves on that principle, we could probably make things more standard and more consistent. And then we need help from the banks to I think, appreciate how their lobbying shows up in the fragmentation that they eventually tell us harms their business model. So.
Great, Caroline, thanks a lot. Also on implementation, Jonathan, of course, you have now developed this international capital standard. This is part of this common framework for supervision of internationally active insurance groups. You approved earlier, actually, the more qualitative part of this common framework. So now, I guess you are in the process of fostering and monitoring implementation across jurisdictions. So what type of challenges you expect to find, and how hopeful you are that at the end of the day you are going to have a much more integrated insurance market along the way?
I'm surprisingly actually quite hopeful.
You're surprised?
Because, well, maybe I'm an optimist. Maybe you have to be an optimist to be a standard-setting body. But, I mean, let's compare to the alternative. I mean, we have gone through a process of developing an insurance capital standard. The reality was we had a very fragmented capital approach across jurisdictions prior to that. And actually, through the process of spending 13 years working on a global standard, we have already seen convergence towards an ICS across the world. So that's a positive. We have another good positive story to talk about our holistic framework, which is our macroprudential standards, where we've done assessments and it's shown actually strong observance of the standards, which actually means I think we can point to positive convergence and implementation of macroprudential supervision in the insurance sector, which will contribute to financial stability. But I mean, a couple of points. I think the one is, in linking you back to the first round, make sure in the first instance that your standards are implementable. So, you know, testing, consultation, the right balance between complexity and you know, risk sensitivity and simplicity. The other, I'll try to be brief. The other quick point I wanted to make is, you know, even when you have a standard, obviously the big risk around fragmentation is in the implementation, but not just the regulatory requirements, but the supervisory practices. Yeah. And I would very much agree with the point that Neil made, that actually maybe the balance between what is regulatory requirements versus what is left for supervision could shift a bit towards supervision. But I also absolutely agree with Elena's point, which is if you're going to do that, you need to make sure supervisors can apply their judgment effectively, because essentially what you're saying is a judgment-based approach to supervision, and make sure that supervisors are properly capacitated. And I think amongst the standard-setting bodies, there's a lot more work to be done around building good supervision. Yeah. And the last point I wanted to make, to bring it back to implementation, is also our implementation assessment work, where I think in some cases maybe there's been a bit too much emphasis in the implementation assessment on a bit of a tick box. Do you have the regulatory framework in place, the regulatory powers in place? And less on assessment of jurisdiction supervisory practices. And I will say I think this is something where we've seen some good. I think what we're doing currently is something that I think is a good trend at the IAS, which is our implementation assessment has now shifted to something which is essentially like a IMF World Bank FSAP type assessment where we don't only look at do you have the regulations in place, but there's also a sort of on-site verification to discuss and test supervisory practices. And maybe that's something to strengthen.
I think it's an excellent point. That of course the drawback of moving sort of the balance from regulation to supervision is much more difficult to get a sort of a global common approach. Because of course supervisory practice, of course, according to the verge across jurisdictions. It's much more difficult to ensure consistency there. It's a very good point. Although the Basel Committee is working on this, right, Neil?
Yes.
Thank you.
That's your intervention.
You can go to Sam now.
Don't get angry.
Oh, no, I'm not angry.
Okay, Sam, indeed. I think I have a question for you. I think you have made it very clear in the context of the interpretation of this secondary mandate that it's in the interest of the UK economy just to adhere to international standards. It's a very strong statement, right? Because this actually sort of is perfectly compatible, even supports the growth and competitiveness of the UK economy and its financial sector. But of course, I see that you are keeping an eye on what is happening in other jurisdictions, so you're basically following how implementation of the Basel standards is evolving in different important jurisdictions. And you have been incredibly vocal about this, very clear. When you actually decided to postpone implementation of what you call Basel 3.1, you said that you need more time for greater clarity to emerge about plans for its implementation in the United States, as an argument actually to delay the implementation of this. So how do you face this little bit of a, if I may, sort of apparent at least, a contradiction between adhere to standards, but at the same time don't do it if you feel that others are not doing the same?
Well, I want to begin by congratulating Neil, because in many, many years of coming to gatherings of central bankers and regulators, that's the first time I've heard a one-word intervention. And that's to be encouraged. It's a new trend. On your question, Fernando, it's interesting. This objective we've got from Parliament has in the objective, it says, subject to meeting relevant international standards. And I think that's very important that is in the objective. There's that recognition that international standards actually play an incredibly important role in driving the performance of global economies. And the reason for that is super simple, that without an international standard, the race to the bottom at some point is not something you can avoid. So I think that is the single most important thing about international standards, actually. Obviously, we've been in a raising phase, but in this next phase, I think that will be super important. We've just published some research which makes exactly this point by somebody called John Thanasoulis and some other colleagues, where it's a thought experiment of what happens if you attach different objectives to different regulators and what happens. And it really just tells you that without international standards being observed by all, you will get that race to the bottom. So I think that's the most important point. In practice, to your question, Fernando, how do we approach this? So if we take the Basel standards as an example, we want to be compliant with the standard. We would live with largely compliant. That could be okay. So we have that as a constraint which we impose upon ourselves, which we think is consistent with the law. And then we say, okay, well, which points have come to us from industry that have evidence attached to them? If the industry just says, we don't like that, well, that's interesting to know, but I don't think relevant to the public interest. If evidence is provided, say, actually, you've got this one wrong and we've got a really credible set of data to show why it's wrong, then of course you take that into account and you say, how much of that can you take into account while also maintaining compliance with the standard? And then also we do look at what other jurisdictions are doing. And as you say, we had this recently, earlier this year, where we pushed back our implementation of the Basel standard by 1 year, because at that point in January of this year, it was completely unclear what the US, at least in our assessment, was going to do. I would say it is much clearer now, and I'm much more optimistic that they are going ahead. So I feel much more optimistic about the position. But we decided to be pretty open about that because everybody would know that was the reason we'd done it. So why not just say so?
Very clear. Thank you very much. Okay, now we have a few minutes for additional questions, comments from...
One question that Jonathan mentioned, insurance front, now a protection gap, meaning that huge gap between economic loss and coverage of insurance, and this gap is growing. And IIS mandate, Jonathan explained much clearly, but now protection gap is a mandate of insurance regulators. So in other words, market development is a key mandate for insurance regulators. And I wonder, this is extremely powerful for the insurance front, but the banking and other sectors, this market development, like fintech or whatever, can be a sort of extended mandate of regulators, particularly, banking side, because sustainability, and of course, coverage of very much, low-income persons' credit and so on, can be regarded as important issue for other standard set of regulators. Nothing totally related to what you have discussed, but this is a little bit,
I think it goes to Neil's question, right? How do you define competition? We're trying to tackle this in Canada right now, and I mean, one that you didn't mention that we've been using is barriers to entry. So how easy is it for a new competitor to come in, and particularly you hear from non-banks or from fintechs, the ability to break into the market, whether it's payments or banking in general, and how much capital you have to have. I think that's the closest thing I can think of to the protection gap definition on the insurance side, or the market development issue.
And maybe from my side, it's always difficult having your predecessor as the Secretary General in the audience asking the difficult questions. But the first point on, you talked about mandates of financial supervisors. I think I tend to agree with the point that Sam made, that actually having a sort of market development mandate is actually a good thing. Maybe it's slightly coming from a South African perspective, and where financial inclusion, market development was an objective. Similar experience. I did not really see it as trade-offs. I saw it as ultimately complementary things. But I do also agree with that it should be a secondary objective, because it is very clear that the worst thing for development is to have financial instability. So that is the absolute necessary condition. The second point I wanted to make is that the IIS, we put out a paper at the end of 2023, which talked about, which was called a call to action, the role of insurance supervisors in helping to address natural catastrophe protection gaps. So, a standard setting body actually putting out a paper on market development. And 2 points in that paper about mandate. One was a little bit this point that actually having an explicit market development mandate for supervisors can be very positive, obviously, for helping to address protection gap issues. But secondly, we actually said that even if you do not have an explicit market development mandate as a supervisor, you should care about the protection gap issue as an insurance supervisor, and you should be doing something about it, even if you don't have an explicit market development mandate, because it is an issue that is relevant to other mandates of financial stability, financial soundness, etc.
But it's more or less the purpose of cost-benefit analysis, right? Even if you don't have a secondary mandate, you care about the costs of your regulation of this type of objectives, for instance. Mm-hmm.
Yeah, I mean, I think it's proportionality as well. It's just do enough to get the outcome that you want to achieve, and not more. Don't get in the way of market development unnecessarily as well.
Great. Okay. I see no. Steve? No. Great. So I think it has been incredibly insightful exchange of views. So please join me in thanking our panelists here.